Sometimes this someone and why they use you and settle. You don't know what remember the lady that you got for the police? Yeah. Definitely use you as a good actress. And then the lady was there. Press down when you want. Then you want to put you in trouble. All right, any question, any development that you want me to know? Anybody?
Hello, Professor.
Yes.
So I had a question about the assignment.
Which of assignment?
The homework and assignment that you gave us last week.
Is it? Okay, all right, go ahead.
So where are we to upload it? There's no link on the Moodle, or are we supposed to email it to you directly?
Oh, I did not provide link.
Yes, you didn't.
Okay, I will do that. So keep it till after the class or during our long break. I will have time. I will just provide a link.
Okay, and also
Thank you for reminding me.
Anytime, sir. So I also wanted to ask about the grading system. Are we to wait for it, or I mean, finance and accounting is the only subject that we haven't been graded.
Okay. Yes.
Are we to wait, or?
Okay. Let's look it between now and because I have a lot of portfolio that I'm managing. Let's say what is today? Okay, if I don't update everything and provide you your current grade today, then please check back the grade book tomorrow.
Okay. Okay.
I will do my best because I know we did a discussion introduction. Discussion 1, introduction, and discussion 2 was question. And so all this, I will get them done today. And then the assignments 1 and 2. I remember all this. 1 and 2. I'll get them all done today. If I cannot finish today, then I should finish them by tomorrow. If you check tomorrow, you see your up-to-date grade. So assignment 1 and 2. Discussion 1, and then I gave you homework, this homework, the one you are going to post to the link. I'll provide 2 links to post the 2 questions I posed to you. I'll provide 2 links. Okay, then moving forward, I was trying to really see us catching up with what we're supposed to do. The way the university handle their own lectures and classes. So I think I'm getting a wing of it. So today we'll be covering chapter 6. Did we finish chapter 6? Anybody answer that questions? I think we did chapter 5 last week.
We didn't even start chapter 6, Professor.
Okay. Me too. I feel that we are starting chapter 6 today. That will be sales revenue, account receivable, and cash, reporting and interpreting. So if we look at all what we are doing now is we are now dissecting, what we're doing now, we're dissecting the income statement, the balance sheet, cash account, stockholders equity. We're dissecting it now completely. Like now today, we'll look at sales revenue. If we look at sales revenue, account receivable, and cash, you will see that we have discussed a lot of things on it already. So we'll be running from now on, we'll be running past. But if you have any questions, feel free to call me back. So please, all right, let me understand this. So we'll be doing that. So this Sunday will be chapter 6, sales revenue, account receivable, cash. And then Monday 27th to 3rd of July, that is a full 1 week. I will expect you to, before coming to class, to read chapter 7, reporting and interpreting cost of goods sold and inventory. You will see that most of these things you're already familiar with it because we did the first part of this course. That is the chapter 1, especially where we introduce all those statements. So you must have been, I know you should be familiar with cost of goods sold. You should also be familiar with inventory. But there will be some additional, like inventory, we want to know the methods. We want to see the inventory methods. That is where we'll look at LIFO, FIFO, we'll look at LIFO, FIFO, and average balance method. So we'll be quickly looking at those ones too. So then, since you are going to work on chapter 7 from Monday 27 up to Sunday, when we'll have the lecture on chapter 7, I will also post to you homework. I want us to do homework on chapter 7. So there will be homework I'm going to post. I get the homework posted by Monday so that by the time you read through chapter 7, you'll be able to do the homework. And then when you come to class, then it will be very easy for us to run through chapter 7. Chapter 7 is cost of goods sold and inventory. That's reporting and interpreting those two accounts. So that is what we'll be looking at. So, and the cost of goods sold and inventory, we'll be looking at bad debts. That is those uncollectible, under account receivable, those uncollectible items. We'll also be looking at them in detail. But some of them will be handling it on this very today that we are working on sales revenue. Okay, so any other question? Any question? Okay, if there is no question, we'll start with, we'll go ahead and look at sales revenue, account receivable, and cash, reporting and interpreting. So let me pick this thing. So University lecture, chapter 6. Did you see my screen, everybody? Did you see my screen, everybody?
Yes, Professor. Now.
Okay. All right. That is reporting and interpreting sales revenue. account receivable, and car. You see that you are familiar with these three items. If I say break down sales revenue from gross, I know most of you will be able to tell me what it is. From gross, you know, the company move, instead of reporting gross, they report from net. If we can recall what we said about sales revenue or sales, who can tell us what gross revenue is and the net revenue is? Who can tell us what it is? Just to refresh your memory, what is gross revenue? Anybody? What is gross revenue?
Yes, Professor. If I'm not mistaken, the gross revenue is the sales revenue, the income, the income from sales revenue minus the cost of the goods itself.
No, that is not. It's a bit different from that, even though you have tried. If you recall, what you are talking about, when you subtract cost of goods sold, that means you are talking about net revenue. Net revenue less cost of goods sold. But when we are talking of gross revenue, gross sales, we are talking about you sell an item, a company is selling an item for $500, and then you say, well, I will give you 10% discount. 10% discount will be less $50. So that means $450. Net sales in this case will be $450. So if you sell three of those items will be $1,500. And because, if you recall, I really illustrated this, and because you have taken care of the 10%, less 10%, but then, because this is 1,500, three items are being sold. A customer may decide to say, one of the customers out of the three may say, oh no, I don't want these items, I want it returned. So if you return it, that will be less 500. So that will be 1,000. And then the discount is 100. So that will be 900. So the net revenue now will be $900, 900. So that is what we call net revenue, gross revenue. Companies generally don't start, they don't report gross revenue. They only report net, less cost of goods sold, and then they keep going. Okay, so if you look at what we are going to learn today, learning objective, analyze impact of credit card sales, sales discount, which is what I've just talked about, sales returns, and sales of bundle items on account reported as net sales. You can see what I'm talking about here. The only thing you are not, probably, maybe some of you are not familiar with bundle items. I want to get most of these things streamlined so that when we go, we are flying past them. We will just be flying. We'll just be jumping and running until we get to where we want to finish. So bundle items here refers to a company selling more than one items to a particular vendor. For example, let me give an example. For example, Apple, we know they have iPad, they have an iPhone, let's say iPhone 12. Am I current? Is it iPhone 12 or iPhone 13 now? I can't remember now. I think it's iPhone.
It's 13 now. 13
oh, it's
now.
13
mini, 13 normal, 13 Pro, 13 Plus.
Whoa. Okay. Okay, you can see I lost count because I don't update my phone every time. Because
I don't like Apple, so I don't care about Apple. I like Hawaii.
Because you keep updating the phone is the same. Is there any difference between iPhone 13 and 12 or 11? Any
I don't
difference?
think I don't think there is a major difference. Just
There is no
size
major
and
difference.
screen size, maybe processor, but it depends on the user, of course.
No, yeah. But in the real sense, I want to use my phone to make phone calls, receive phone calls. Basically, the primary service is the same. That's not changed. Okay, all right. So this is Apple. Apple is selling iPad, maybe 3 iPads, and then is selling iPhone, maybe also 3 iPhones at the same time, because this is a company. The company want to give the managers iPad, iPhone, and maybe also include the service. The service maybe like extra service in case the phone break down or get lost, they will reimburse. So that is service. Service maybe service. Some people will buy service 2 years, 3 years, 5 years. I know you understand what I'm saying. If you buy 5 year service, for example, within 5 years, if anything happened to the iPhone, if it is broken or lost, the Apple people will want to replace it. I don't know. There may be some hidden problem with it, but I don't know. But let us assume. So this is a company that went to Apple. They said, "Well, we want to give our managers iPad, iPhone." So these are bundled. This is what we call bundle. They bundle all this iPad, maybe 500 each. That is 1,500. iPhone, maybe 1,000 each. So that would be $3,000. Service, maybe service. If you take 5 year plan for each of those phones, each of the service will be maybe $100. 4 times the 3 phone, that is 300. So remember, this is 5 years for the service. So if all these items are being paid for, you will see that the company will only, that is you, the Apple will only recognize 1,500 and 3,000, 4,500 in year one. For the first year, Apple will recognize 4,500. My question, what happened to 300? 300 is for 5 years. Will they recognize 300 for the 5 year, for 1 year, for that same year? Who can answer that question? Who can answer that question? Will they recognize 300 for that same year? Because already they have recognized 1,500, 3,000, iPad 1,500, iPhone 3,000. So what of the 300? Will they recognize it? Who knows? Okay, I will explain. They will not recognize the 300 for that year one. For year one, they will not recognize all the 300. But because the accounting is for each of the financial year, so this 300 will be divided by 5 years. If you divide that by 5, that will be $60. So that means each year they will recognize $60. So their sales that will go to sales revenue will be 4,560. That is 4,500 plus 60. So the other remaining 240 will be in a different asset account until it is recognized. Okay. Any question? No questions? Okay. So that means that bundle is the only thing that is different there that you don't know. Every other thing that you should know. Then estimate, report, and evaluate the effect of uncollectible account receivable. So we have account receivable, collectible, and uncollectible. So we'll be able to look at that too. Account receivable, we know how it's created. Everybody know now that when a credit sales is made, it goes straight to account receivable. And then when customer pays, they credit that account back. That account is credited back and cash will be debited. I think we all know all that entries now. So that will be account receivable. And then the bad debt, a company must have an idea of what, for the total sale, what will be the percentage of bad debt. It's based on experience, it's based on operations. If the company is used to not collecting out of $100, they only collect $80. That means their bad debt provision should be 20%. Bad debt provision should be 20%. That is not to say the actual bad debt will be 20%. It may hover around 20% because from experience, from idea, they have not been collecting out of $100, they collect only $80. So the rest will be bad debt. So bad debt account will be created, and if they are able to pursue it eventually, then they will be able to reverse that entry. But as soon as you make that bad debt provision, as at the time now, you are now saying, okay, what is the actual bad debt at the end of the year? At the end of the year, you will now say, okay, it's still 20%. So that means what will happen? You have to reduce your revenue by that 20%. That means bad debt is a very key issue that management must focus on seriously. Otherwise, you make all the money, you give it out. That means you are indirectly giving out the revenue to your vendors if they don't pay it back. Okay, so that will be analyze, interpret, receiving. Then we will look at the turnover ratio. And recall, most of these things we are doing, we are running through ratios. They are very important. Very, very important. Ratios are very important because it tells us the performance of the company in terms of collecting their debts and so forth in this case. Then we look at report, control, and safeguard cash. How the cash must be well controlled. How do you control cash? We'll look at it at the tail end of this lecture. Okay, analyzing the impact of credit card sales, sales discounts, sales returns. So we look at that. When revenue recognition principle require that revenue be recorded. So when the company transfer goods and services to customer. So as soon as, I think we discussed it, is it last class or week before last? How do you test that you can, yes, recognize this revenue? Number one is that you must value that goods you are going to send out. If you value it, say it's $50 worth of goods you are sending to vendor A or to customer A. The next step is you have to now make sure that goods is transferred and ownership of that goods change. Because when the good is in transit, you are sending goods to me, it's in transit. Ownership has not changed. So you cannot say, yes, we made these sales. No, it's only when that good is delivered, ownership has been transferred from the company to the customer. At that point, you say, yes, these goods had been sold. And the key remaining part of it, yes, there must be acceptance. If you send goods and put it at the door, maybe the customer was not at home, you drop at the door until the customer pick the goods, open it and use it, and yeah, constructively say, yes, we have made these sales. Or the customer may say, okay, yeah, you have knowledge received oh, I've seen these goods. You have knowledge received that, yes, I've received the goods and confirm receipt. At that point, the company can now recognize the sales. So we talk about net sales, and I've told you much about net sales. So maybe you have to go through this slide, but then what may be different here, we have what we call FOB, and we have what we call CIF. I don't think CIF is here. CIF, meaning of CIF is cost, insurance, and freight. That means the person who is accepting the good will have to pay. Then this one is freight on board, destination. So in that case, as soon as they ship the goods, the title of the good change hands on delivery, because it's FOB, free on board, FOB. So that means as soon as you send the goods and the goods change hands, then the goods have been delivered. You can go in detail to look at that. Then recognition of revenue, we have talked about it a lot. So you should know now when to recognize revenue when a sales is made. Then credit sales. Credit sales, all these are under the computation of getting to the net sales. When it is credit sales, yes, discount, yes, you have to deduct. Credit sales, the only difference in credit sales is that credit sales account receivable must be debited because the goods has been passed to customer. Customer has accepted the goods. Yes, sales need to be recognized, but cash was not received. So that is why we are using account receivable. Then we look at sales discount to businesses. Sales discounts. And for businesses, in most cases, those who buy large quantity of goods from the manufacturer companies, at times we have what we call the 210. That is, if you make your sales, if you make these sales within 10 days, then we will give you a 2% discount. So a lot of companies will save by doing that. Instead of waiting for 30 days. Because if you look at this, that means sales is for 30 days. After 30 days, customers have to pay. But what of taking advantage of, it may be very large, maybe goods worth about $1 million. Imagine goods worth about $1 million, and you are going to save 2% of that. That's a big chunk of money that will improve your cash flow. Most customers, most companies will want to take advantage of that. Any questions so far, so good? Any questions
Professor,
so far? Yes.
Professor,
okay, go ahead.
Go ahead.
as
Okay, you are on
professor,
first.
to download today PowerPoint file and also chapter 4, 5, and 6. We cannot find in good Moodle. Thank you,
Oh,
Professor.
wow. What chapter? But I thought you have your textbook. I would send the chapter PowerPoint maybe today, since I'm going to sit down after the lectures. I will send the PowerPoint. But of what good will the chapter PowerPoint do for you? Because you have the textbook.
Yes, sir. But we would like to study more your PowerPoint lecture and also the reference also too.
Okay, all right. Let me put the PowerPoint as my to-do today.
Thank you, Professor.
Yes. Just 1 minute.
Yes, sir, because sometimes we got keynotes from your PowerPoint when we study it. There are so many, sentences or maybe the pages in the reference books. Thank you, Professor.
Okay. Next question. 7, 8. Somebody wanted to ask a question.
Yes,
the next person. Yeah, go ahead.
So there is sales on credit and there is sales by credit card.
Mm-hmm.
Okay, so by credit means the customer will buy the item and receive it and start paying the price on installments, right?
Okay.
This is sales on credit. While sales on credit card, okay, the company will get the full amount from the bank, but the customer will pay in installments to the bank. Am I right? Am I right?
Yeah. I want us to look at the credit in just two narrow sense so that it will make more sense. A customer buys on credit. If he buys on credit, he buys $50 worth on credit, it's not paying you. You as a company is not paying you now. And then you say, well, my credit policy is 30 days. So between now and 30 days, pay me. So such transaction will go into account receivable. So what are the entries? You debit account receivable and credit sales. Am I correct? Debit account receivable and credit sales, that transaction is done. So sales have been made.
I'm not talking about the transaction. I'm talking about
Don't
the
worry.
concept itself.
I'm looking at the concept. You look at the concept in terms of practical application of what we are talking about. We are not here to discuss theory more. We discuss theory and practice. So account receivable will be debited and credited. That is credit sales. But the other way too, customer
Okay.
may, let me come.
And the payment.
Let me come.
Okay.
Let me come. Don't be confused with payment. It depends. If it is 30 days, I'm going to go to the other credit because we still have to talk about the other credit. You mentioned two credit issues. But for this credit, the customer has 30 days. If there is no prior arrangement, the company that gave them the goods on credit will expect payment on the dot, 30 days. But at times, to make their life very easy, you may say, okay, you can spread this payment every 5 days or 2 days or 3 days until you get to that date, the final date. That is by installment. But that does not change the accounting concept. It does not change the financial consideration. But if
I understand this.
Okay, that's okay. So if now a sales is made on credit card, and
Yeah,
what
this
I
is my
will add
question.
here, huh?
This is my question. What is as I said, sales by credit, the credit means not immediately, but within a certain period.
Mm-hmm.
Okay, but what about credit card? Because
this is what.
yeah,
Let's talk about credit card. If we want to dig deep into credit card, I will break it down into two. One, credit card in-house. That is, the company has a credit card. And the other one, the person is bringing his own credit card from another company to buy the goods. So if you bring credit from another company to buy the goods, yeah, cash will be given, recognition will be given straight away because the company is going to take the money from the credit card right away. But if it is credit card from the company itself, the company, the bank issue the credit card on behalf of the customer, behalf of the bank. So behalf of the company. So in that case, payment will be made, but the bank will have to credit the company. In that case, the bank will credit the company. If the company charge that credit card $50, it is the bank that will transfer $50 to the checking account of the company. There are so many things about credit, but I just want us to, in most cases, restrict it to credit that the vendor receive. Because also the company may give you credit. It's okay. You are buying these goods $600 on credit. And when they tell you pay by installment for 12 months, that means 12 months is the maximum number of months that you have to pay back. 12 months. Either they tell you, okay, every month pay this until the end of the 12 months. If it is 600, pay $50 every month until 12. By the 12th month, you are finished paying payment. Or they may say, okay, pay me in 12 months. So at the end of 12 months, exactly 12 months, you pay 600. So repayment is not the issue. You look at the credit itself, the credit card, the credit sales. That is what you look at in totality. Look at it, look at that picture and see how you will handle it in accounting sense.
So if we are facing, theoretically, if we are facing a question saying that the company made a sales by credit card of $1,000. So in this case, the cash is increased immediately by 1,000 because it's credit card sales.
Yeah. Okay.
Right?
Yeah. Yes. Correct. You are right.
But if the company say it did sales of $1,000 by credit, so the accounts receivable, the accounts receivable, right, will increase $1,000, not the cash.
But it's not credit card sales.
It's not because, yeah, it is on credit, but not credit card.
Oh, very good. You're right. You're right. Very correct.
Yeah. Clear.
Yeah. Very, very correct. Very good. Very good. You got the concept. Okay. All right. We'll pass that. Okay. Let's look at reporting net sales. I think also, if you have no question on this slide, we'll pass it also, because I talk about this because this aspect of it is not always reported. Sales less credit card discounts, sales discount contra revenue, and where this discount comes from. Who knows where this discount comes from? Credit card discount. Anybody knows? Okay, I will explain. The credit card discount here we are talking about is a company is encouraging you to take their credit card. Most standard company have their own credit card. Who can give us any example of a company that has its own credit card? I don't want to be the one giving all the examples. Who can give us an example of a company that has credit card? Nobody. Example of a company.
Sorry, Professor. I was talking and my mic was closed.
Oh, talk now.
Okay. Based on an experience here in Kuwait, the banks are making like agreements with the companies. Okay, that if the customer buy any product by credit card, the company will give them 2% discount or 5% discount. So it is, and the bank is using this in like advertising or encouraging the customers to get credit cards.
Encouraging customer, because that is where they make all their money. But then if it is the bank, then you will see that it will not be a charge to revenue here. If it is the bank, like if you look at, I would talk of Apple. There are so many companies. In fact, even here in US, Walmart, they have their own credit card. They have MasterCard. Okay. So they may tell you that, look, if you sign up with for our MasterCard today, for this goods you are paying, we'll give you 25% discount. So supposing it is $100 goods, you will see that they will give you a discount of $25. So that is the discount we are talking about here, credit card discount. Walmart, they are encouraging you to get their own credit card issued by a bank anyway, but then it is theirs. It is their own credit card. So it's not the bank that will incur that discount. It is Walmart that will incur the discount because they are the one promoting their credit card. And all the benefit of that credit card interest all goes to Walmart. That's why they will encourage you by all means to take it.
So they're acting like a bank.
Most companies, yes, not necessarily acting like a bank, but they have their own credit card, and they will prefer you using their credit card to pay. So because it will be a win-win for them. You pay the interest, you pay the bill, the charges, and then you pay for the goods. So if they want, even if they give you $100 discount, they don't mind. Even if they give you $200 discount, they don't mind because they will know within a very short period, when you pay the interest, you pay for the goods and so forth, before you know it, they have recovered all whatever discount they've given you. This one is just to entice you to come and get. But the credit card issued by the bank itself, that is, you will not see, like most company credit card, you will see there, Walmart, and then you look at it. What type of credit card? Visa. Or what type of credit card? MasterCard. So in that case, if they now want to sell to you, in most cases too, it may not be at the beginning of the credit card you are signing up. They may say, anytime you pay with our credit card, we give you 10%. There are so many companies that are doing that. So many. It's anytime pay with our credit card, we'll give you 10%, because the more you overdraw that credit card, the more money they make on the credit card, and then they will also make the sales. So it's a win-win for the company. That's why you see them, they will always encourage you to use that credit card, which is different from bank credit card. But it's the bank that issue the credit card anyway. But it is Walmart you will see on the name, or it is Apple you will see on the card. Nobody else. So it is theirs. So in that case, that discount will be applied to them. So they will now absorb that discount. Like in this case, you can see the sale revenue is $6,000 less $60 discount. Okay, that is credit card discount, then sales discount. Then you can see the return and allowance I told you about. Returns and allowance, 500. Then net sales is this. Any question? Okay, let's go. Let's go. Okay, let's go. Okay, net sales on income. So you can see now, when they are now reporting, you can see this is Skechers USA Incorporation and subsidiary. Consolidated statement of earnings. Year ended December 31st. So you can see, this is for this company. You can see all those things we discussed before they arrive at this net sales. Now you all know the numbers, the theory behind getting that net sales figures. Is there anybody with any question? Because you may have a question like that, and I would not want you to make those adjustments before you arrive at net sales. So you can see 2019, their net sales is 5.2 million here. 2018, 4.6 million. And 2017 is 4.1 million. So in terms of sales performance, what do we say about this company? If you look at this number, what do we say?
Sales are increasing.
Yeah, you can see in 2019, they have hit 5.2 million. So sales is almost increasing by about 10%, right? So they are doing very well in terms of sales. In terms of sales, they're doing very well. But we don't know about cost of goods sold, if it is higher or lower. But we'll see it later on when we're doing the analysis. Okay. So volume and discount rebate, I don't
Professor?
see. Yeah, go ahead.
Can you go to the previous slide, please?
Or the previous one? Okay, this one?
Yes, what is royalty income? What is royalty income?
Royalty income has to do, those companies that they want to segregate those who are being royal to the they want to segregate those special income in terms of what did they get in terms of royalty. What did they get? That those are the people who are carved out, who are, no matter what, how bad, how good the goods are, they will always buy from this company. They want to know what percentage is that in terms of income.
So it's the usual customers.
The usual customer, but this one they have ties with the company. They have some good connection with the company. Like for example, I know that in Middle East there you have family account, family companies. Most companies are family companies run by families. I want to know the contribution of income that the family itself are giving to this company. It's not a question of this company is working.
Are they buying the goods of their own company or not?
Yes, they must buy from their company. That, like for example, clothing, right? If I am a company, this is a family business, I am producing a buyer, I expect all the women in my family to buy a buyer from that company, right? So in that case, I will be able to track what percentage is that income is to the company. Okay, volume, we don't really need that. Okay, revenue recognition for bundle. I think we have handled this at the beginning. If you look at it, there are 5 steps there. For one, you identify the contract. What I was doing when I was looking at it was the contract I was trying to draft. If you remember, Apple, iPad, iPhone, services, okay, and then what are the terms of payment, the value of the payment. So you identify the contract between the company and the customer, identify performance obligation, promise goods and services, determine the transaction price. You remember at the end, 3 Apple, 3 iPad, 3 iPhone, and then I was able to say, okay, this is the total of this, and then I add services as well there. So services is for 5 years, or for 4 years, 3 years, depending on how much you want to pay. Like some people will go, they say, well, I'm giving them this money because this product will never get that bad. And in most cases, if nothing gets wrong, they pocket the money, right? They enjoy it. It's a free money for them as far as they are concerned. So determine the transaction price, allocate the transaction price to the performance obligations. So services is for 2 years. So if they pay 300 for services for 2 years, then you do, for each year, you have to recognize only $150. You can't recognize all the 300 for first year. So recognize the revenue when each performance obligation is satisfied. Okay, for the iPad and iPhone, probably they have transferred their ownership already. They have given it to them, they have transferred ownership. So they will recognize that, so they will recognize revenue right away for that year. But for service, the customer paid for service for 3 years. So they have to divide it by 3. He paid for 4 years. You have to divide by 4. I know if you go to the stores, they will always say, oh, do you want service for, you want it 5 years or you want 3 years? What do they really call it? Anybody? what do they call it? Is it
Warranty.
service? Warranty? Is it warranty? They run away from warranty. That is why I'm asking, because so many companies have different names they give it. Do you know that if they call it warranty, it's a duplication? Why? Because the product itself, by law, it has a warranty. It may be 12 months warranty. So they don't call it. In most cases, some company used to call it extended warranty. But I think they drifted from that to something else because the law catch up with them, they change and so forth. But in any case, you will pay. You go there, they will say, okay, you can pay 1 year of it. So that means we cover your good for 1 year. But don't forget the fact that there is warranty on the product. And in most cases, you who is smart, if you talk to them, they will say, no, that one is limited warranty. It's very limited. That may not be true. Because if your product breaks down within 12 months, they have to replace it. But in any case, you take 12 months or you take 2 years and so forth. So, but they don't recognize revenue until the obligation is satisfied. Okay, let's take a 10-minute break and come back. We take 10 minutes and come back. Stretch our leg a little bit and refresh again and come back. Okay. Okay, let's look at revenue recognition bundle. But I think this is almost like what I have already discussed. Now you know what bundle goods are. Who can explain what bundle goods are before we pass these slides? Who can explain what bundle goods are? Who can explain what bundle goods are? Somebody need to explain it before we move. So I know that you know it. Silence means that,
So bundle goods when a good and service are together, are sold together, like as you mentioned, 3 iPhones together, and you get a certain discount.
Yeah, even if you don't remember, at least you use my own example. That make it very easy. Bundle goods are when you put different type of goods in one contract, and then those goods are now transferred to the customer, including weather services is also part of it. Not necessarily phone, anything you are selling, or you can sell the same type of goods, but different contract. Contract one has to be, so amount have to be paid. So those are bundle goods. Different goods emanating from different contracts or different type of goods. Just like, that is why Apple is a very good example that we used. So Apple is a very good example. So if we look at it like here, revenue recognition for bundle goods and services. So Apple sells an iPad for $500. That $450 of which relate to the hardware with essential software. So $450 is the iPad itself, and $50 of which relates to future software upgrades that will be provided over 5 years. Okay, this is similar to the example I gave, which is good. Then after applying 5 steps process, revenue from the contract will be recognized. So you can see that the $50 is for 5 years. So you can see year one, only $50 will be $10 will be recognized. So not all the $50. So in that case, it will be $460 because the product is $450, then $10. So $460 will be recognized in year one. So now you are taking payment for the iPad and taking year one service. So year 2, year 3, year 4, then you will dispense with the remaining services. So all together will give us the 500. I think we handled that already. So looking at receivable, and in most cases for receivable, I always want you to just cast your mind back. You know how receivable is created. Even know how receivable is created, then we don't need to waste our time looking at it again. So that is the theory behind it. So who can tell us how account receivable is created? Account receivable. Who can tell us how account receivable is created? Somebody else, not the gentleman that I've been talking all through today with me. Somebody else, if possible, a lady. How is account receivable created? How is account receivable created? Somebody help us. How is account receivable created?
Hello, Professor.
Yes.
So I think it's a payment which is rendered a product. For example, if a business sells a product or service to its customers, but they haven't been paid. Orders. I don't know how to put it. So let me
try.
just
You are doing very well. Yes.
Okay. So services or products that customers have ordered but not paid. So the product is delivered to the customers, but they haven't been paid for.
Oh, very good. Correct. You have the last thing you said there is delivered. Account receivable, nothing will happen to account receivable, nothing will happen to sales if the goods are not delivered. Ownership of the good must be passed. If you order iPhone on online, until that iPhone is delivered to you, that is at that point, ownership has been transferred. That is at that point we say, yes, this sales has been made. But because the customer recognizes you, the company recognizes you that, oh, she is very good in payment, we'll give her 1 year to pay. So that means 12 months, the difference will remain in account receivable. So we recognize sales because iPhone has been delivered to you and you have taken possession. In fact, you are enjoying your iPhone already. So we'll recognize sales at that point. So in that case, we'll credit sales for the value of the iPhone, $1,000. And you recall that for every credit, there must be a debit. So that debit will go to the asset account, that is account receivable. So account receivable will be debited 1,000. So you can see this cancel out. 1,000 credited to sales because we have delivered the goods, the iPhone to you and you are using it. And then we charge the other one debit, goes to account receivable. If we have that idea, then we know everything about account receivable. So you should not have any problem as far as that is concerned. We also have what we call foreign currency receivable. That I will skip it a little bit, but just what you know, we do what we call, we revalue that currency anytime we are preparing to prepare our income statement, we have to revalue it because foreign exchange rate always is not stagnant, except some countries. Some countries they fix their currency, so you don't need to do those revaluation. It's only when you receive currency, you now calculate what it is equivalent, and then credit it to your account, to the company's account. But for the company, for the countries who don't peg or fix their currency, in that case, they will be doing this. They will be doing foreign currency receivable revaluation every now and then to make sure they are very current. I know there are some countries like Saudi Arabia, they fix their currency, they peg it at 3.75. I know that, so they don't need to do any adjustment entries. Every time they receive $1, you know that $1 is 3.75. Is it 3.75 riyal? Am I correct? Okay, so every time they receive it, it will be 3.75, nothing else to be done. You just convert it 3.75 to $1. I know in United Arab Emirates, I know too, theirs is 3.50. So anytime they receive dollar, that's 3.50. They just convert it But there are some countries who don't fix their exchange rate. They have what we call variable exchange rates. So in that case, those countries, what they do is every now and then, anytime they want to prepare their income statement, they have to do the revaluation. Because at times, the exchange rate will fluctuate upward or downward, depending on what the movement of demand and supply of foreign exchange is in the market. So that is what we should take note of on foreign currency receivable. So estimate report evaluation effect of uncollectible account receivable. I told you, if now we talk about account receivable, anytime the money is not collected, it's uncollectible. So in that case, like I said at the beginning, the company will first of all make what we call provision. Provision means we are not 100% sure of the numbers, but we are just making provision. So they will make provision for bad and doubtful debts. And it's based on experience. In most cases, it's based on experience of operations. If the company feels that 10% out of every $100, 10% will not, $10 will not be collected, then that means they will make provision for 10%. But at the end of the financial year, they are going to prepare their balance sheet. Any account receivable that is not collected, probably the actual numbers, the actual figures is say 8%. So in that case, they will charge 8% to their income statement as a bad and doubtful debt account. So that is what you should take note of in this objective. So doubtful debts, bad debts, results from credit customer who will not pay. So these are the customers, they don't pay, maybe because of financial problem, constraint, whatever be their problem, they are unable to pay. So expense recognition principle require recording of bad debt expenses in the same accounting period in which the related sales are made. So that is it. So it must be recorded. It must be, we have to make provision. Then at the end of the financial year, the actual numbers is what will go to the income statement. So if the actual number is, you make provision for $6,000, but the actual debt at the end of the financial year is $5,000. So $5,000 will be debited. Debit is $5,000 to income statement, and then you credit account receivable and doubtful debt, $5,000. So that means with 6,000 provision, we have over provided. The company has made over provision. So in that case, the difference still will be will stay in the income statement. Any question? Any question? Okay, so this is we have talked about it. This is how the bad debt expense is taken care of. You can see you debit that expense accounts, and then allowance for doubtful debt is credited. That down allowance
Professor,
for yes.
in terms of the loss to the company, okay, is it loss of the in relation with the bad debt? Okay, it is the loss for the company as the cost of the goods, right? As the actual costs of the goods.
No, okay. What is revenue? Before you before you derive revenue, cost of goods sold have been taken care of, right? And then plus what we call margin. So wasn't the cost of goods sold is say, let me say is $100. margin is 20%. That means the sales will be $120, right?
Okay.
So for this, yeah, $120 per product. So now we gave 2 products to this customer, and that will be $240, correct?
Correct.
Okay, so $240 is where we make provision.
So this 240 is the cost of the goods and our expected profit, right?
Very good. Yes, and our expected profit. You will not pass make provision for 120, and the expected profit taking care of so many things, you know. So if you only charge only the cost of goods sold, you have not taken care of the time we went, the factory overhead, the salary, so many things that have gone into making that sales. For example,
no, this is what I'm talking about. If the cost of the product to the company, this is including everything, the labor, the time, everything. The cost of the good itself is $100, and the company is selling it for $200, for example. Okay, so in case of bad debt, a customer bought it for $200, but he didn't pay the $200. So in this case, the actual loss for the company is $100.
It's not. It's not 100, because what of the time?
Yeah, this is what I'm saying. This is what I'm saying.
Okay, what of the yeah, it's not 100. So just take note. Whatever is being given to customer, let's forget about much of the abstract technicality. How much are we selling these goods? One good. We are selling it at $120.
Okay.
Okay, let me use your number. We are selling it 200. Probably we gave the customer 10 products, right? 10 products is how much? 2,000.
2,000.
Okay. Also, another customer may take goods 3,000. That is 30 of it. That is maybe 4,000. Another customer may take. This customer who took 4,000, he paid everything. He paid the 4,000. The customer who did not pay, the 2,000 become bad debt. He didn't pay it. So we have to make provision. We have to either charge this to income statement. But mind you, if we look at it, 2,000 plus 4,000, that would be 6,000, correct?
Yes.
The first step is base. I told you this one is subjective. We are not sure of the actual numbers here. When we are making provision, it's based on experience, based on what we have been experiencing for the years. Oh, out of this $6,000, only $600 will not be collected, or $1,000 will not be collected. So in that case, we make provision for $1,000. We make provision, bad debt provision, $1,000. We do the adjustment entry, we pass all the entries. But then, at the end of the year, we realize that 2,000 was not collected. So the actual bad debt now becomes 2,000. Whatever is the sales number, we don't do any dissection whereby it's okay, let's remove this expenses, only let it be cost of goods. Cost of goods is only the product and factory. So what of other inputs? It's a loss as far as that very goods is concerned. So if it is 2,000 cost of goods sold, if it is 2,000 sales and it's bad, that is we are deducting that from an income statement. That becomes a loss to the company. But it's a loss to the company. So at the end of the year, let's say the company financial year ended 31st December. Okay?
Okay.
31st December. So at this time, 2,000 is bad. We gave the customer 60 days, he did not pay. And then we follow like that till the end of December 31st, he did not pay. So 2,000 is bad debt. So this 2,000, if our income, if that is, when I say our income, that is income of the company. If the income of the company is, say, 20,000 as at December, less bad debt, we have to subtract that. That is the way the GAAP say we must do it. So the now the income of this company will be 18,000 because we have taken bad debt into consideration as at December. So as at the next year, January or February, the company come back, or the customer now come back to us, oh, I've collected, oh, I'm sorry, I did that, but here is your 2,000. We have been able to recover from our problem, financial problem. So that 2,000 now will go straight to income. So we do the adjustment entry as well, and then we charge that to income. Any question? Any question?
No, Professor.
Okay, so that is what we call writing off in specific uncollectible accounts. So those that we have charged is a write-off. It's a write-off, and you don't report such income. You don't report such income until, okay, our income is 20,000. No, your income is not 20,000. It's because 2,000 is bad debt. So your income is 18,000. So that is what we will be charging off for the year. So financial analysis also, we do financial analysis here. You can see how we work on the entries that we pass. Most of these entries passed by computer these days. You can see account receivable is debited 677, allowance for doubtful debt is credited 677. And then that is if you collect this money, like I said, we collected back the 2,000. If we collect the 2,000, yes, now we debit it to account receivable, and then we credit account doubtful debt. Because you remember when we made that doubtful debt charge off, we debited allowance for doubtful debt. But now that in January, the customer came back and bounced back and returned the 2,000. So now what do? That means he has paid us back cash 2,000. So we debit cash 2,000, and then we credit it to account receivable, and everything now even out. Okay, so those are the entries that you can look at for bad debts, the two-step process. First of all, you make provision adjustment. The next one, you identify the actual bad debts as at the end of the financial year, and then you take appropriate action. The following year, or the next 2 years, 3 years, 4 years, 5 years, if you recover that money, fine. You credit it back to the respective account and the income statements. So that is still the summary of all what we have discussed about doubtful debt accounts. Let's look at, I want us to look at the percentage of credits. Like I mentioned before, is that based on experience. This credit is not cast on stone. It's based on experience. You know what to attribute to the percentage of credit expenses on bad debt and also bad debt provision. These are based on experience. Nobody has the number that they said this is the actual number. It's based on experience that you'll be able to say, okay, let's make provision in this manner. These are all true about most of these things we have discussed it, so I will just pass them. If you have any question, you can always call me and ask me, or you can always send your question across. Okay. Here we are looking at what again? Percentage of credit sales, bad debt expense, and income statement. All these are charged to income statement as at when they are incurred. And bad debt, what you should know is that the first step is making provision, and then at the end of the year, you charge the actual amount. And that is what you call the actual write-off compared to estimate. You remember I keep saying the same thing, that as at the time you are making provision, it's just an estimate. It may be 5%, 10%, 20%, but at the end of the year, you now look at those customers. Company will have millions of customers, thousands of customers that they have given credit. Now they look at them one by one. Oh, this one was due January. This one was due in March, they did not pay. This one was due in September, they did not pay. Now they look at those customers, maybe 10 of them in total. How much did we give to them? Oh, we gave total of $50,000 worth of sales to them. Oh, okay. So in that case, this is the actual amount that will be charged to income statement. Okay, so another thing that I want us to really look at is control over account receivable. Very important. Control over account receivable. So in this case, how do you control account receivable? It will be based on the profile of the customers you are dealing with. And most companies here have approval standard and level of approval. So like in United States, we talk of customers' credit history, very important. And we have what we call scoring system here. I don't know, I will ask the Kuwait person to tell me if they also have what we call the credit scoring system. Our credit scoring system starts from 300 up to 850. So a customer would say 650. Yeah, 650 probably may be a very good credit for some customers, for some companies. So in that case, if the customer falls between 650 and 850, yeah, it's possible they will extend credit to the customer. And then that is first thing you take note of. So they look at credit history. Based on credit history, they should be able to approve at the appropriate level. Appropriate level means who has authority to now approve that credit, because money is leaving the company. Somebody must approve it and take responsibility. So if the customer score between the numbers, I'm giving here an example. Some customer may not look at 650. They may say, oh, this you must be 700 and up for us to approve. That is what we call credit scoring system. As soon as you scale that hurdle, then the manager approve. Okay, when the managers approve, so that means we are really controlling our account receivable, because one, credit is an issue, and periodically we have to always make sure we keep tab of the customer as a company. You cannot just give money out and then say, okay, that's it. I don't care. After all, it's 30 days. Anytime you want, you can always come and pay me. No, you must also keep tab of the customer, make sure that the customer is still doing well to be able to pay back, especially those that are nearing end of the credit period. You have to take check and make sure the payment will be received. And then we have to reward both sales, those who make the sales and those who are now going to do the collection of the proceeds. We have to reward them. We have to reward both so that there will be an alignment. We want them to work as a team, because if the salesperson knows that it's only collections personnel you are going to reward, they may not want to do it. They may just say, okay, I'll sell to anybody. it is the job of the collection. But if you now reward both departments and make sure they work as a team, yes, account receivable will be well controlled. So for account receivable to be well controlled, one, we look at the credit scoring system, and then periodically we have to review account receivable. Anyone nearing end of the period of the credit period, we have to really keep real surveillance to make sure the customer refund, and then we have to reward both credit, both sales and collection personnel. So those are the things we really have to look at. Any question? Any questions so far? So far, so good. All right, okay, so everything we do, we look at ratios as well. So in this case, we are looking at receivable turnover ratio. It measures how many times average trade receivable are recorded and collected for the year. That is what we call receivable turnover ratio. And also, at the end of this course, at the chapter 13, you know, we are going to now put everything we have been coming through ratios, coming through the interpretation of it. So we'll put everything together and call it financial statement analysis. That will be the last part of our course. So it's good as you see the ratio, you try to go back and look at them again and practice. So comparing, when you look at comparing ratio, look at this company. If you recall this company, your turnover is 11.4 here, 10.2, 9.1. And looking at comparing with other companies in the same industry, this company in 2019 is 6.6. Cross in 2019 is 12.1. You will see that the company that is worse off is Cross, 12.1, while this company here is 6.6. This the company we have been looking at, 9.1, 10.2, and then 11.4. So this is increasing. So we must know what is going on with this company. Okay, account receivable, like we said, the effect of it is, as we collect cash, that account is supposed to go down. So if you add any account receivable, the account increased. But when we now collect cash, the account receivable reduced by the amount of cash collected, and the cycle continues. As you make as you sell on credit, that account increase, and then you collect cash, that account reduce. So you subtract when you collect cash, you reduce, and then the cycle continues. That's the cycle we are looking at now. The cycle continue until, I know for a big company, there's no way that account will be zero. As far as the company continue to make sales, that account can never be zero. Any question? Okay, no question.
Why
so
can never be zero, Professor? I mean, why the account receivable cannot be zero? Because if it is paid, then it will be eventually be zero.
Okay. Yeah, if we are dealing with, we have a company that is stagnant, that is going into liquidation, yes, that account will be zero. But do you know the account we are dealing? Do you know the type of company we are dealing with? What type of company we are dealing with? Who know the name? The technical name of the company we are dealing with. Technical. It has a technical name. We mentioned it when we first started.
Apple? I don't remember, to be honest.
No, that is a particular company. Okay, the company we are dealing with is what a company we are called the company going concern. Going concern. Going concern. Going concern. Did I make myself clear? Going concern. That is the type of company we are dealing with. A company that is keep producing income and keep going. And the company, because we know that company exists in perpetuity, that is for life, forever. We expect the company to exist all through life. You come in as a manager, tomorrow you are gone, but the company still remain Apple. Apple remain Apple. That is a going concern. So that is the type of company we're dealing with. As soon as the day Apple stop production and start selling, yes, that account can be zero. But presently, there is no way account receivable in Apple will be zero.
Professor, let me ask. So
Yes.
I wish to know about when we take the test, the question form is only the MCQ or answer the questions or essay types? Because now when we check about this, there are so many things we need to learn, or maybe we need to memorize everything a lot. So I would like to know about the question types. Because for example, now in assignments, so hard for us to understand about and to answer it, but we try the best. But in the question, in the exams, what kind of types we need to answer, how we should prepare for it?
The same type of question we were looking at number one type of question is true or false. We have discussed so many things. We have the PowerPoint, we have the notes. By now, we should know what true or false. Any items, any statement made, we know whether it is true or false.
Yes, sir.
Okay. Number two is multiple choice question.
Yes, sir.
They are giving questions. You are now told to pick the best answer. That is true, false.
Yes, sir.
Number three, also, maybe at times I may make a statement and omit one or two items as we fill it up. So that is another one. Then number four, I will always want to put in ratios. Ratios, because at the end of this course, if you cannot do financial analysis, then there is a problem. If you cannot do financial, then you have not gone through this course. Because at the end of it, I want you to do financial analysis. So ratios, for example, if we are now working on quiz number 2, we'll be looking at all the ratio we have gone through from chapter 6, 7, and 8. So we'll be looking at those ratios, turnover ratios, account receivable ratios, and so forth. So ratio will come in. So I will give you I'll give you a scenario. I'll say this is it. What is the ratio of this company and so forth, and then I say interpret the ratio. Yes, ratio has no meaning if you don't know the theory behind the ratio. Ratio has no meaning. So you have not only computing the ratio for this course or for an MBA program, you must also know what the interpretation of that ratio is. And first you interpret the ratio based focus on the company. Compare the company to close competitors, and then compare the company to industry standard. Industry standard, they have all the ratio, they have all the performance indicators. You just go to the industry and check what it is. So those are the way we will do it. And then final exams, we'll be looking at financial statement analysis proper. That we'll discuss later on. The only thing I will do for quiz number 2, before we do the quiz, that will be after next week, is that I will discuss likely questions with you. I'll open likely question, we look at it together, and then before I'll give you the questions for quiz number 2. So it will be likely questions. We look at it together, and then you expect some of the questions, and then also those will be the likely questions we have.
Yes, sir.
Okay.
Yes.
All right. So we're looking at learning objective, the last one, how to control. This here we are talking of controlling cash. The company's cash is very, very important. You can see, as far as GAAP is concerned, cash is the #1 item on the asset side. Based on GAAP, why is cash #1 item? Who knows? Who remember what we discussed already? Why is cash #1 item?
I think, Professor, it's because in terms of liquidity, it has to be on.
Very good. That is the most liquid of all assets, and is reported under subheading of assets. What is that subheading? We know what the subheading of asset is. If we have all this background, you can see now we'll be flying past most of these topics because we know it already to some extent. What is the sub area under which cash is recorded under asset side of balance sheet? Nobody can help me
Can
or
you
help
repeat the
us?
question, please?
I say we know an asset, everything is arranged, and somebody rightly pointed out that cash is the most liquid. That is why you see it recorded #1 on the balance sheet asset side. But asset is not just assets. We have it subdivided into different level of assets.
Current and non-current.
Yeah, current assets. Current asset is where you record cash. You record cash. You record short-term investment. You record inventory, prepayment, and all those stuff go under current assets. And we record them. GAAP has a very way of doing it, which is very good. As soon as you see cash, any item you see next to cash is the next in liquidity. And then you see, for example, short-term investment. Short-term investment, we know that is, in most cases, what we call it is quasi-asset. Quasi is QUSZI, quasi-asset, because that is semi-cash, quasi-cashed, or quasi-current asset, because it is next to cash, quasi-cash. So it's listed like that. So, but cash is the most important lifeblood of any company, so it must be well controlled. Any company that declares huge profit and you don't have enough cash to pay salary, creditors, that company will go into bankruptcy. Before you know it, the company is closed down. So cash is very important, so it must be well controlled. And how do we control it? There must be clear line of authorization, and the cash you have in your small till is not the cash we are looking at. We are looking at the cash, we are looking at it in the cash account or balance sheet. So cash account in the balance sheet is 50,000 as of today. Is that what you have when you add what you have in the till, what you have in the bank? So that is when you now go to the bank to reconcile what you have. Because what you have as the balance sheet item or cash account must agree with what you have in the bank in a way. With the adjustment here and there, everything must tally. If they don't tally, then there is a problem. And then because of fraud and fiddle, you have to control, those who will handle cash, anybody who is handling, making authorization for the cash to be released or to be received. Somebody receiving cash should be different from somebody who is authorizing, should be different from somebody who is holding the physical cash itself. in the company. And then somebody will do the bank reconciliation. You can see these three, when you put out this group of people, you will put them differently. There is no way cash will not be well controlled. And then there must be internal control. That is where you have the internal auditors. They have to make sure and certify that the cash, what they have in the cash is the actual figure. Any question? So you can see here, yeah, okay. Cash and cash equivalent. We look at cash equivalent, like I said it, investment especially, short-term investment, short-term. Long-term investment will not appear under current asset. It will appear in a different place. Okay. So cash, effective cash management involve more than protect cash from theft, fraud, loss, through carelessness also. So we must report accurate accounting so that the report of cash flows and balances may be prepared. So those we have discussed. So now effective internal control of cash. If you look at separation of duties, prescribed policy and procedure, there must be policy and procedure in place about cash. Very important, because cash is the lifeblood, life wire of the company. Without cash, if you like, declare 5 billion profit, if you don't have the real cash in the bank, wherever you keep them, then you cannot operate. So you can see for separation of duty, separate job for receiving cash and disposing cash. Very important. Separate procedure of accounting for cash receipts and cash disbursement. And then separate the physical handling of cash. Somebody physically handling the cash, you must separate. And you add up, you can add to this, the fourth layer is that somebody should be there also. He's not touching the cash, not seeing the cash. What he's dealing with the books. That person should be the one reconciling the cash. You cannot give somebody who is handling the cash to also do the reconciliation. There is compromise. If it is 50,000, yeah, if the person has taken part of the money, there is 50,000, he has taken 10,000. Yeah, you can reconcile and say it's 10,000 that I have. But the person who is reconciling, in most companies, they get somebody in the internal control, that is among the internal auditors, auditing department, to do the reconciliation, bank reconciliation, I mean. So bank reconciliation, you will see most companies, they will send you to the bank, go and collect our statement. What are they trying to do? They want to get the statement, but don't send somebody who is handling the cash itself to go and collect statement. You may not see that statement, or you may doctor that statement before you bring it. So you must get somebody who is independent of these three arms of receiving cash, accounting for cash receipt and cash disbursement, and then handling the real physical cash. It must be different from any of them. So you must have a policy in place as to how much can be received and deposited in the bank. Approval of purchases and actual cash payments must also, so in most companies have approval limits for managers, the CEO, and so forth. So all that must be in place. That must be in line with the corporate policy. Okay, ethics and the need for internal control. If you remember when we did the SOX Act, they emphasize the need for internal control. A well-run company should have strong internal control in place, and that is the internal audit department, so that they will oversee most of these things, including cash. Although the vast majority of employees are trustworthy, employee theft costs businesses billions of dollars each year. Yeah, before you employ somebody, you must run through the background and so forth. But then there's still problem. And most of these people, employee that get themselves involved in theft, cash, and so forth, why did they make? What was the motivation? In most cases, some of them say the motivation is because it is so easy to get the money and go. So that means the company don't have good internal control in place. So this is an example of bank statement. Everybody have a bank account. So your statement is there. Your statement you must see debit and credit and then the balance. So this will be reconciled generally. All this will be reconciled with with your own book. That is the company's book of cash account. Must reconcile and make sure it is balanced. And in most cases, for you to be on top of it and well controlled, it must be balanced on daily basis. On daily basis. On daily basis. Otherwise, something may go wrong and then you don't know. So need for reconciliation, transaction affect cash were recorded in the book of the company. Errors in recording transaction. Errors in recording may cause cash difference. So you must reconcile everything and then make sure it balances with the bank account. Any question? So bank reconciliation accomplished two major objectives. One, check the accuracy of the bank balance, and also identify any previously unrecorded transactions. There may be unrecorded transactions like interest. You didn't issue check on interest and bank has charged you, or bank charge you on, there are so many charges bank can take. They may charge you on turnover, say, okay, you have to pay this, turnover on your account is this. That you don't have. So you will capture all unrecognized transactions and also changes and anything that is unusual. You must capture it and reconcile it to the bank statement and and also your own statement. So you can see here we took a look at ending cash balance pay books. So this is the book of the company. And then look at the bank statement too, same period. They must agree. The last reconciliation agreed these numbers. So now there were some items not captured. So you now capture items here, and then you agree to this. And then you can see this balance must be also correct balance of this. And if there are errors, then you have to chase the bank. If it is the bank make errors too, in most cases, probably a check that is meant for another company has been debited to this account. So that is the essence of the reconciliation. So you tell the bank, oh, there is $100 check that you charge to our accounts. We did not issue that check. Oh, it's a mistake. So they will correct. Based on that, the two statements will always balance. Any question, Kwame? Okay, you can see this is a typical cash balance in the book of the company and the bank. You can see both must always agree. If you reconcile it and put everything that is missing into it, then if they agree as at today, then the bank reconciliation has agreed. And if there is any fraudulent transactions, because you don't wait until a very long time, you can nip it right there and know, oh, okay, this $5, who took this money? We don't know about it. The bank have records, so they will be able to tell you what happened to the $5 and so forth. So these are all bank reconciliation statements you can do. And then based on that, we should be able, it will affect our cash account, hence the asset account, and hence the balance sheet. Okay. So credit card, discount, and cash accounts also, we discuss a lot about discounts. Most companies have their own discount account, and yes, it will affect cash account if cash is being recorded at first. So it will definitely affect the cash account. Okay, so I think that will be what we cover that is very important. We have covered those aspects that I feel that are very, very important as far as revenue recognition, account receivable, and then cash account is concerned. We have covered every aspect of that. So next week, or starting from Monday, we will be looking at chapter 7. Start reading chapter 7. I'm going to post everything up to chapter 7. I will post chapter 7 this time because I'm giving you an assignment, homework assignment for chapter 7. And chapter 7 also is reporting and interpreting cost of goods sold and inventory. There are a lot of things we'll look at when we're looking at inventory, method of inventory. How do we value inventory? We'll be looking at the LIFO, FIFO. I know maybe some of you have seen it, and then average balance method. Those are the three methods. Company use any of those methods. LIFO means last in, first out. When we look at that chapter, when you read that chapter, you see what last in, first out means. And then FIFO, first in, first out. So that is what we'll be looking at. Then the average balance method, calculate all the value of all the inventory divided by the total number of the product, and then we have the average, and then we multiply it by whatever is used for the production for that year. We'll be looking at that next week, starting tomorrow, chapter 7. And also I will post on Monday. For this one, I will post also the homework that I want you to do. I've agreed that I will bring your grade up to date today. If I can't finish today, by tomorrow, if you check, you will see it as what you have. So what I will be posting is for the what assignment we have discussed already, discussion 1, discussion 2, assignment 1 and 2, and then homework. I'll post a link for you to post the homework today as soon as I finish this lectures. I'll post the link so that you post. Then I will start working on your grade so that you know where you are. As at by tomorrow, you should be able to get the actual grade for the course. So what will be left for you to add will be today's the homework for next week, then quiz number 2, and then final exam and maybe one other homework, and then then you add that to it, then you will know the actual grade. Everybody know how to calculate the grade, I suppose. Any question? So that I'll start my work now. Any question?
I have one question about last time's homework.
Okay.
So it's about the gross profit percentage of Apple and the industry, and to compare it with other competitors. So I wasn't able to find the industry's gross profit percentage throughout different years, but I found a median or mean percentage of the industry overall. Would it be okay to use one for
don't use the median. Don't use the median because median look at outliers. That is, they look at the worst and the best, and then they find average. Use the mean.
The mean, okay. So Okay, so it doesn't have it doesn't have mean or median or anything on different years. It just states it generally. It doesn't state years.
Yeah, they
So
mean whatever you have now for the industry, use that one. Because the
okay, so
industry, they keep changing, they keep updating from time to time. But the latest one you have for the industry, that is the one you use for the comparison.
okay, so I can just use one for all different years.
Yes.
From 2018 up to 2021, I can use one median of the
Yeah,
industry.
use one. Yeah, use 1 million. Even though 1 million, even though we will have a little or no information from a previous year for the industry. Why? Because a company is moving, everybody is moving. We are futuristic, so we are looking into the future. So when you are comparing for industry, if you use the same, that's okay. But what we'll be interested is the current year, what the comparison is for the current year. We'll be more interested in that. But for previous year, yeah, for knowledge, yes, just for background information, but the current year will be more critical.
Okay.
Because current year, if Apple is not operating within, is operating below industry standard, that is a critical information for us to look at and dissect. So like I said, I promise I'm going to post the link right away so that you'll be able to go there and post the 2 items. Any questions? Any other question? And then competitors, you know, who are Apple competitors? Who are Apple competitors? 1 or 2 examples? Anybody know?
HP and Dell.
Very good. HP, Dell, there are so many of them, but HP and Dell are 2 big players. Even to some extent, Samsung, based on the product. But I will not want to use Samsung because Samsung is also into other things like home appliances, televisions, and so forth. So, but let's stick with HP and Apple and HP, Dell as competitors. That's very good. Any other question? Any question? Okay, if there is no question, we'll stop there so that I'll have some time. Yes,
sir?
Yeah, yes.
Excuse me, sir.
Sir,
So our next assignment for this week, can you repeat it?
For this week, this chapter, we just finished sales revenue and receivable. I will not give you any homework on this sales revenue, the one we just completed on Sunday. What I want to do, I'm trying to modify the way we should be approaching this course. I know, because when we first started, I used my own method and the way I've been teaching in other universities, but then we have to modify to suit our occasion. So from tomorrow, Monday, you should study chapter 7, reporting and interpreting cost of goods sold and inventory. And I will post, there is a homework assignment I'm going to post. I will post a homework assignment, so as you read through, you should be able to answer the assignment. So in that case, when you come on Sunday, we will now run through chapter 7. By that time, you have done the assignment on chapter 7, and you have read chapter 7. So we will not waste much time on chapter 7. We'll just run through it. If we finish on time, you will go and then focus on something else. So there will be homework 3 that I will post on June 27th. That is tomorrow for you. So I will post that so that you'll be able to use as you read, you go through the problem and then get them done. So by the time you come in on Sunday, we'll run through chapter 7. It will be very, very straightforward. So our quiz number 1 was based on chapter 1, 2, and 3. Am I correct? Am I correct? Quiz 1.
Chapter 1 to 3, quiz 1.
I said our quiz 1 was based on chapter 1, 2, and 3.
Okay.
Okay, our quiz 2 will be based on chapter 5, 6, 7. So immediately we finish 7 on Monday, the 4th of July, I will post quiz number 2. So we will find time on Sunday to review quiz number 2. Like today, we are finishing on time. So next week, I hope we'll finish on time so that we'll have time to review quiz number 2. So that I will post the quiz number 2 the next day, and then you have up to Saturday to do the quiz. Did I make myself clear?
Okay, yes. Yes, you are.
Okay. All right. If there's no, is there any other question? Okay. If there is no question, have a beautiful week. Go through chapter 7. Go through the homework on chapter 7. The due date, final due date on chapter 7, homework will be Saturday. You make sure between Monday and Saturday. Don't do the homework before reading the chapter. Read the chapter first before you do the homework, so that you will not miss anything on the homework. So do the homework, read the chapter up to Monday, Tuesday, Wednesday, and then Thursday, Friday, Saturday, you can start looking at the homework. Okay? Thank you very much.
Thank you.
And have a
Professor.
great week. Yes?
Thank you, Professor.
Have a
Thank
great
you.
day.
And you too. Thank you. All right. Bye-bye.
Bye.
Have a
Thank
nice
you,
day,
sir.
Professor. Thank you.
Bye. Bye.
Bye-bye, sir.
Okay.